Hello, it's Craig Larson with Larson Financial Advisors for our market message on June 17th, 2013. I'm going to cover a couple things today, an update on the financial markets, and secondly, some significant changes in interest rates that we've seen. Number one, as far as financial markets, we're starting to see the pullback in things that we've expected over the last few weeks. The good news is that the U.S. stock market continues to hold up remarkably well. It's not even down 4% from its peak a few weeks ago, and that includes the S&P 500 and also the Russell 2000 index, which measures the more of the small company aggressive stocks. They're holding up well too. It's encouraging to see that. We may see some more downside work throughout the summer here, but so far doesn't look like it's too serious. Where it does look more serious is on the international space, particularly the emerging markets, the funds or stocks that are concentrated in China, India, Latin America. Those things really got clobbered in the month of May. So we'll keep an eye on that, but we think that there's some pretty substantial rotations happening in the international space, and an investor just needs to be more selective in that area. Some of the other areas that dropped a little bit more were utility stocks, some high dividend payers, and some real estate investment trusts, namely due to the change in interest rates. So there may be some opportunities in some of those areas. We're seeing some of those still scoring well and great entry opportunity, whereas others are breaking down. So again, it's a time that you want to be more selective, but there's definitely opportunities out there. Number two, with interest rates, we've seen some pretty substantial shifts in interest rates up over the month of May. So for instance, the 30-year Treasury bond yield went up almost 0.5%, which is a huge move in 1 month. So now we want to remind people, if you're invested in bonds or bond funds, you need to be very careful about what types of bonds or funds you're owning, because some are extremely vulnerable to price drops when interest rates rise. However, not all of them. There's some categories of bonds and fixed income which will do just fine in a rising rate, but the key ones you want to watch for are U.S. Treasury bonds and investment-grade corporates. One way that we measure the risk to those things internally is with a number called duration. And duration simply says, based on a rise or a fall in rates of 1%, how much does your principal value rise or fall? And for instance, in a 30-year Treasury bond, your duration is about 20, meaning that if interest rates rise 1%, you could lose 20% of your principal value. So again, right now, you want to evaluate. If you haven't yet, and you're not a client, please call us. We can help walk you through that process. We can stress test your portfolio and make sure that you're in the right places. So thanks for tuning in. Look forward to talking with you again in the next couple of weeks.